Hello and welcome to the latest ARC Spotlight. I'm Tom Lemon and I'm delighted to be joined by Jeremy Hermant, who's an SRT specialist. Jeremy, thank you for joining me. Welcome.
Thank you. It's a pleasure to be here. I like SRT so much that I dedicated the last 10 years working in this field, and I spent the last 18 months working at Alantra advising banks on that.
Great. So maybe then, to someone who's not super familiar with SRT, can you sort of just give us a quick rundown of how it works, what it is?
Yeah, so SRT has many names, SRT, CRT, CRS. They're all the same product. They're mostly synthetic securitization, and the goal is credit risk mitigation. Banks will transfer risk to the buy-side sectors, mostly cash investors, hedge funds, or sometimes insurance companies.
And the market's seen a real tremendous growth over the last few years in particular. What's changed the most in those years?
So at first, SRT was created in Europe to help banks fulfill their capital needs. These capital requirements have increased post-GFC, so we've seen the market increase slightly, ticking up every year since 2010. The big increase started in 2015-16 when the European regulation changed for the best. Most recently, in the past 3 years, we have seen two factors. One of the big factors was the US entrance. So US investors started investing in SRT because the regulator allowed US banks to originate. So a lot of money was piled up in the US for this purpose. But the US market didn't grow up as expected, so US money flocked to Europe. The other factor was the Credit Suisse debacle 3 years ago, where AT1s seemed a little bit less sure, less secure, and large investors such as pension funds, sovereign funds started looking at SRT as a mature market.
And what are they really looking for?
When you look at SRT, you have diversified source of credit risk. When you're a credit fund, you look at credit risk in the sense of risk benefits. You are putting some money at risk and you're getting paid for it. Contrary to other bank instruments, SRT are directly linked to assets, so you can diversify your position in auto loans, in corporate, in commercial real estate, so you get a much more granular investment. And finally, what you get as well is a very strong support from the regulator. In Europe, since 2017, we had a build-up of a very strong and clear regulation, helping investors having a good path, a very clear set of legal tools that help the product to become more standardized and almost classic now.
And that seems to be one of the weird things about it at the moment, is that you hear stories that regulators are unhappy or taking a closer look at SRT. But when I talk to people like you in the SRT market, you talk about how closely involved the regulators are.
Yeah, the SRT product is a co-production. It's a co-production between banks, investors, and the regulator. We had seen back in December 2025 a fast-track report being published by the European regulator, so showing that the regulator wants this product to be streamlined, quick and efficient. Having said that, we are in the middle of the creation of a new regulation in Europe after the European Council paper that was published back in October, following the Commission paper back in June, and now the Parliament is currently designing a new law, which the goal to make SRT more efficient for some asset classes. So during this process, everyone is going to voice their opinion around SRT. And of course, as usual, when you voice an opinion, you are going to highlight the positive, but being a regulator, which is your job, you also have to highlight the negative aspect of things. So maybe journalists are focusing a lot on the negative aspects of things, which is their job as well. And like all financial products, some risks are embedded, and we are not unaware of this risk in the industry, but we are very cognizant that these risks have been mitigated, tackled, and accepted.
And where do deals become most challenging? Because you mentioned how long they take, and how easy is it for them to fall apart?
So, talking about timing, an SRT transaction can take between 3 months and 2 years. The average being between 6 and 9 months, and because they require a lot of work on the data. Your main hurdle is the data quality, and the availability of historical data. You need to be able as an investor to be sure that your future risk return will be aligned to what happened in the past. So you need 5-10 years of historical data. If you don't have that, then the challenges started. And the quality of data, obviously. So that's your first problem. The second problem is the regulatory environment. In Europe, it's very, very clear. In the UK, it's becoming clearer. We're getting a new regulation in the UK in January 27. In the US, we are still waiting for the regulation to be clear. As we all know, the US is a little bit in an uncertainty situation right now. And finally, it's the asset class type. Most of the SRTs are now SMEs or corporate transactions. A lot of new asset classes have emerged in the past 10 years. Consumer, auto, and then commercial real estate became more popular, and we are all expecting residential mortgages to be a large chunk of the market. So data, regulation, and asset granularity are your main three pointer of risk when you look at the transaction.
Could something like residential mortgages impact the public RMBS market?
Yes and no. So public RMBS market for residential mortgages is used mostly for funding purposes, whilst SRT is a credit risk transfer. So you don't look at the same side of the capital stack. Residential mortgages are very used by non-banks, and they are very used by banks to diversify their source of funding. But they don't sell the risk. They just sell the non-risky part, the AAA, AA part, whilst SRT looks at the other side of the risk, which is the non-rated or the very low-rated part of capital stack. And you would expect maybe constraints, so meaning that banks are going to mobilize some assets for RMBS, for covered bonds, but they don't use the full mortgage pile for that. So the part that is left on the side that is not used for covered bonds or RMBS could be used for SRT.
And the hope, I guess, is that by doing more of this, banks are then able to lend further into more corporate areas.
The goal of SRT. So the goal of SRT are multiple because you are increasing your capital efficiency. You're basically tapping the market at a cost of capital which is much lower than your internal yield of capital. You are going to do that for many reasons. The first reason is increase your capital buffer. If you increase your capital buffer, you have a better capital path for the future, you have better ratings because you have more absorbency of risk. You also can do an SRT for, M&A purposes. So if you want some capital to deploy in an acquisition, SRT is also a good reason. You can also do that pre-IPO or just to increase your ratios if you're a listed company to improve the visibility of your profitability. And finally, you can also tactically use SRT for specific assets that are very risky. So you are less in the regulatory capital environment and you're more in the economic capital environment.
And you touched on it with mortgages, but how do you see the market evolving over the next couple of years? Obviously, there's regulation coming in and changing.
So that is always the $1 million question to predict the future, because no one can predict the future, obviously. But what you can see is on the existing pool of assets, more banks are going to issue. The product, as we mentioned before, is very standardized. So for a new entrant, is the easiest situation is right now, because you have a fast track by the central banks being issued. You have a lot of investors. Now we're talking about 100 investors, and the pricing has been very, very positive for banks. So growth of the number of issuers. You also see a growth of the size of transactions. So for existing pool, we can see more and more issuers coming with larger books because they are seeing more appetite from investors. Investors, they want bigger size. They are a little bit more, have a better risk appetite, a larger risk appetite, so transactions are growing. In terms of new assets, my belief is mortgages, synthetic SRT for mortgages are going to be added to the pool more and more. We saw a couple last year, and we're expecting more this year. And that will be linked as well to the insurance investor appetite. Insurance are a natural home for mortgages, synthetic SRT, so we can expect more of that. There was a paper last year from a large US bank, and we expect like them that the market will double in size in the next 2 to 5 years.
One of the things I find interesting about it is that it's a private market, but now it's growing so much, it feels like greater transparency is just inevitable. There's no real up-to-date, accurate data that's easy to find. A lot of it's unrated. Do you think that those sorts of things are just inevitably going to change?
So you have transparency and transparency. I can tell you that everyone who has been involved in an SRT transaction has a lot of data that has been circulated to the regulator. So from a regulatory point of view, SRTs are super transparent.
Yeah.
You provide all the pool, the structure, all the legal documents, and the investors have as themselves to report to the regulator. We don't see many public SRTs because it's a lot of work. It's too much data that can be confidential, especially if you deal with individuals, to the cloud, to the public market. Having said that, there is a phenomenon on private markets becoming more and more public. We can see that with the large asset managers trying to raise money on the public market. So I will not be surprised if some SRT goes into the public market in the form of a fund that is open to public. So there will be more disclosure. However, I don't believe SRT market will ever be as transparent as the equity market or the public bond market, because the nature of the pools, of the loans, this is the secret sauce of banks. So they don't want to disclose that on the open. They disclose that very, very strictly to the regulator, and I think it's enough.
And what about the funding side? Because I guess one of the problems that regulators have looked at, and maybe the media has looked at, is this argument that to some degree the risk isn't actually leaving the banking system because the asset managers who buy it are funded by another bank.
Yeah, so the repo market has always been a concern for the regulator because banks were lending money to investors. But this repo market was much different from the SRT risk itself because it was very, very short term. The letter published by the PRA last year, so the Dear CFO letter on repo, was very clear on what the PRA thought about the illiquidity of SRTs. Having said that, when you look at the repo conditions from banks, with a large haircut on the collateral, on the SRT tranches, is a little bit, how do you say that properly, mitigating this illiquidity risk. If someone sells me an SRT tranche at 50% of its value, it is very liquid. So there is a big debate on that. However, the new leverage type we see that are no longer repo, they are more correlated to the insurance market. So insurance providing guarantees on tranches, then banks lending on that. This helping the risk getting out of the banking system, and banks' liquidity can be used for limited leverage. What we see now is hedge funds are getting coupon of between 6 and 7% on SRT, while the threshold of return is around 9%. So they don't get a full leverage on the SRT transaction, they get a bit of leverage. What I'm expecting from the regulator is to ask for a map of the repo and the leverage and make their opinion on how systemic it is. It is their role to have a look and to criticize. It's also the role of the market to justify that the systemic risk that we saw during the GFC is no longer present. What we see in the new EU regulation proposal is that insurance companies that will be involved in SRT cannot be monoline, have to be large, and have to be able to provide a risk report that makes sense. So in this respect, I think leverage is useful. Leverage has been well done in the past because of a large haircut, and this new type of leverage we see will be also very controlled.
And just lastly then, I guess, what is the biggest misconception, I suppose, about the market that you'd love for people to realise, to correct, shall we say?
Many of them, but the biggest misconception is that synthetic securitization is not reliable. Because when we issue a transaction, we have to provide to the regulator, to investor, the assets that have been referenced by the bank. The way banks are referencing the loans are within their systems and the governance to control that the loans are actually in the transaction. Then each time you have a credit event on the loans, you have a third party analyzing these credit events. So the misconception for me is that synthetic securitization are a door to fraud, to not properly disclosing your credit events, which is not happening, which is really curtailed by regulatory, investor, and third-party scrutiny. And to be completely honest, the past scandals we have in the US, for example, recently have happened with cash securitizations. So synthetic securitization have a lot of bad press, I think because of the general media and movies that happened in the past, but they are extremely, how do you say that, checked at every step of their life.
Yeah, perfect. Well, Jeremy, thank you so much for your time. Really appreciate it. And thank you for listening.